Your moderator for this session will be Matt Gamser. He's CEO of the SME Finance Forum. Can't read with my glasses on. And the panelists up here with him, Samuel White, who's the regional manager for Asia for Creditinfo. Dr. Meng Li, who is a director at JD Finance Institute. Sarah Davies, who's head of risk and analytics at Nova Credit. And we have Ritwik Ghosh, who is head of the lending business and operations at Grab, sitting in for Ankur, who had to drop at the last minute. So, Matt, over to you.
Thank you very much, and thank you, BIIA, for inviting me again. I was here 2 years ago, and I had a great time. And in fact, one of the things that most impressed me was the willingness of the folks at BIIA to really look openly and critically about the state of the industry and to actually use this biennial meeting not to just do a lot of mutual backslapping, but to really ask hard questions about how can we continue to improve and what do we have to continually question and reassess about our model. And that's a good thing because, you heard an expression in the last panel that maybe we need evolution, not revolution. Well, you're about to have the revolution, not evolution panel, which I have deliberately, with my assent from BIIA colleagues, tried to put together a group of panelists who are going to explain to you why business as usual will not suffice. And even though two of them actually represent, if I would call them new age credit information business models, and two represent very radically different models, all of them hopefully are going to talk about different ways of looking at things than we have earlier today. And we're going to focus in particular, as was just said, on what do we need to do to make sure we can include many more people in essential financial services, whether that's credit, whether that's savings, insurance, payments. So we're... I say this in the context of the SME Finance Forum, which was created by the G20 and we manage at the IFC. It's a growing network of people from the financial sector writ large, and many of the companies in BIIA are represented in my membership and friends. So please don't take this in the context of we're trying to have at you, and we're also using for us. Companies like Experian and S&P and CRIF are fintechs. We don't dispute that, and there are also fintechs that do financing themselves, and there are fintechs that don't. But what we do need to be open to is how we might have to look at data and look at the way we use data and the way we conduct our business in a different way in order to open up, especially in markets where exclusion is the norm and inclusion is the minority. But even in developed markets, I think we'll talk, where Samuel has some experience, we'll talk about that. But so let me start by letting the panelists introduce themselves briefly to you. We're going to go with in the order of age of the companies. So the oldest company in our group here is Creditinfo, which started way back in 1997. But just to put them in a different context than CRIF, which I should say is one of my members, so I'm not trying to say this as a criticism of CRIF, but when you started in 1988, you're a pre-internet company. When you started in 1997, you are a post-internet age company. So Samuel, tell us about Creditinfo and why was it even felt that there was a need to start another credit information agency in 1997?
Well, thank you, first of all, for inviting me to this panel. It's a difficult question why this started in 1997. Basically, the owner of the company, a majority shareholder today, he felt that there was a need to use this innovation, the internet, to start providing access to credit information using this platform. So that is basically how it all started and why it started. But in terms of the company today, Creditinfo has operations in 26 different countries, and on this subject and topic, financial inclusion, many of these markets we have expanded to and invested in are dealing with our markets, developing markets and emerging markets, where a large percentage of the populations and the SMEs do not have a formal relationship with a credit facility. So this is why our company has invested quite significantly in alternative scoring and alternative solutions to support this, let's say, challenge, and we still continue to do so.
Right, so as was said in the previous panel, because you've been focused on markets where alternative data is the only data, because there's very limited banking relationships that make up traditional data, you've had to take a different approach. Very interesting. Now, I'm going to violate what I said was my approach, because I'm actually going to skip to Sarah, which is a much younger company, but is also in the credit information company model. Now, your company started only in 2015, and it's focused actually, it does a lot of work in developed markets, right? Especially with recent migrants. Why was it felt necessary to start a new credit information by that original group from Stanford, and what are you doing? How are you taking a different cut at this, and because of who you're trying to include?
Yeah, thank you, Matt. So Nova Credit started 2015. You may have met Misha Esipov, my colleague. And it started out of the fact that Misha and a few of his friends came to the US for school and were not able to get credit. The reason for that was they didn't have a credit score. And the reason for that is that the dominant score within the US environment requires that you have 6 months of history and a credit file in order to get a score. So for a large percentage of the student population, the immigrant student population in the US, these people were not able to get credit, not able to get any access to lending tools and things like that. So Nova Credit started really as that student project. And the process was simply, how do you integrate access within a number of countries where you had a high flow of immigrants coming into the US. So we've integrated with Canada, Mexico, India, the UK, Australia, many other countries after that. And the model pivots on a pretty significant component, which is consumer permission. So as long as the immigrant student is willing to give permission to have their credit file pulled over into the US platform, then we're able to access the consumer's file, bring that data over and present it to a lender. And so that's sort of the essence of the model. We have been in a variety of pilots for the last 18 months. Notably, though, the most important one was with American Express, which we started about a year ago, and at Money 2020 in Vegas last weekend announced a formal partnership with American Express, who've put us into production. So for them, they've certainly seen it as a successful model.
So fascinating, and with a focus on a subject we haven't talked that much about today yet, but is critically important in this increasingly connected world, cross-border data access. And we'll come back to that, I'm sure, because that's, and with unprecedented numbers of people in migration today, this nice little US pilot is clearly one that has potential in many other places. Now Meng, your company is older than, because in 2002, the original JD started. For those that don't know JD or Jingdong, it was originally a physical store in China which distinguished itself selling electronics because, and please don't get me in trouble with my Chinese owners in the World Bank here, but what distinguished JD was that the stuff was really the stuff. It wasn't counterfeit in an age when, for those of you that have worked in China for some time, in 2002 it wasn't that easy, whether in China or Hong Kong for that matter too. And Hong Kong is a part of China. It was not easy. But that soon became an online platform, which many call the Amazon of China. But relatively recently, only from 2013, did JD start getting interested in building a financing operation. And why in a country like China, which has so many banks, so many bank branches, And so many people with actual records in the credit bureau. Was this considered necessary? What are you bringing in that was needed?
Well, I should talk more about JD.com. JD.com is the second largest online retailer in China. And as an online retail platform, it connects 400 million customers and 8 million SMEs. So we can see that the two groups are quite new. The SMEs, they are very small scale companies. And for the C side, they are young, and most of them are from the sinking channels. I mean the third and the fourth tiers Chinese city. So for this kind of, for this young and lower tier cities individual, maybe they don't have any credit information from the traditional organization. After we run a business like this large, we found both from the C side and the B side, there are strong financial need inside them, and it's easy for us to develop a solution for them because based on the alternative data, we can see their preference, we can see their ability to pay back the money on time. So we just have the advantage to start our financial business.
So interesting that even in a place with so much investment in infrastructure in recent years as China, those hundreds of millions of consumers and 8 million, I think it was, small businesses still don't really have a sufficiently thick file in the conventional system but on the other hand, you, unlike an aggregator, you didn't have to aggregate because you were the owner of this data on who was buying from and selling to and where all the boxes were going. And that was the starting point for your building. We'll go back into that soon, but I just want to round out the panel. Grab, as a ride-hailing company that many from this region, I'm sure know, it managed to run Uber out of town in much of Southeast Asia. It still has some interesting competition with the likes of Gojek and others, but what is less known is just how much more than ride-hailing Grab has got into and how in 2017 it formed also a financing arm. So maybe, Ritwik, if you could tell us a bit more about, what was the motivation for that? Again, you're working in many different markets. What do you feel you're bringing that wasn't already there?
Happy to, and thank you. So as we know, Grab started in 2012 to solve a customer problem of point-to-point transport, which was risky, expensive, often unsafe, often unavailable in parts of Southeast Asia. Now, it took us 3 to 4 years to really get to a point where we felt we are delivering something that is really world-class, and that was part of the reason why we were able to beat Uber or being able to establish our presence. But then when we looked beyond just the transport service itself, which is solving the taxi booking thing, what we felt is a large part of the problem in the customer journey as well as the partner or the driver's journey is the way the transaction is settled. And we saw 80 to 90% of transactions are still settled in cash. Singapore might be a little bit of a difference, but that's an exception. Across the region, it's in cash. And cash leads to all kinds of leakage, friction, fraud, and a lot of the bookings hence got cancelled, and there were value leakage from both parts. So first, Grab went into saying, okay, can we solve a customer problem here by enabling cashless payments? Then we realized a lot of our consumers either did not have a cashless payment method, like places in Indonesia, Philippines, or even here. And secondly, which is even probably more pronounced, they didn't want to attach their cashless payment method in a ride-hailing company, or in fact anywhere where it gets saved because of safety and security concerns. So that led Grab in 2017 to get into what is GrabPay, essentially an electronic e-wallet, right? And then that's a stored value e-wallet, which helps you seamlessly transact on Grab. Once post that transition, what we then started realizing is we are not just in the business of O2O commerce, giving people rides, we have in fact ended up acquiring in some way or other daily engagement of 100 million plus consumers in Southeast Asia and 10 million odd drivers, agents, riders. And when we are the only company which has this sort of scale and this sort of engagement, our opportunity to serve that ecosystem better is just natural. And hence, we then started a couple of other businesses, all in financial services, lending and insurance. So Grab Finance, which is the lending part, and Grab Insure, which is the insurance part. Again, when Grab Finance started, which is only about 18 months back, and that's why I'm the last in the panel in terms of order. So the newest business within Grab itself, in fact. We started with a very core focus on credit access, where credit access isn't there. And for our drivers, that's predominantly true. And now that part of the problem we've been able to address. We're looking at merchants who are on GrabFood, GrabPay. Again, a lot of it is about working capital needs that they don't get from formal sources. And in fact, even consumers. That's probably the third play that we're looking at.
So this raises both for you and for Meng, you represent institutions that in addition to that you have access to this wonderful financial transactional database that you're able to use, but at the same time you also have this additional access to data that goes beyond financial transactions because you started in other parts of a commercial ecosystem. To what extent, in the last panel we were talking about what data is augmenting traditional data and what data is really replacing. It seems like neither of those makes sense with respect to your two business models because you're in a completely different world here because it's not just about finance for either of you. It's about a bigger package and where everything finance reinforces the commerce and commerce reinforces the finance. Is that a reasonable way to look at it? Or?
Yes, the way we look at it is, I think if we come from a very fixed construct of the type of credit we want to give, which is let's say a housing loan or a student loan, and then you back calculate from that decision to this type of data you need and all that. We don't operate that way, right? We are coming very much from what is our ecosystem. In that ecosystem, what are the needs of different participants and what are credit-related needs? So to be very concrete here, let's say a lot of people take Grab rides. Every time you take a Grab ride, you either pay in cash or you pay in credit card, debit card, whatever, and you actually may not know, end of the month, how much you have spent taking Grab rides. And then you probably are paying for each of them transactionally. So we want to package it together into a product which is pay later. So it's a postpaid service on Grab, right? Now it is a credit product, but that credit product doesn't really require us to go into traditional data sources, dealing into your bank account, how much money you have, whether you defaulted, 90 DPD 5 years back. What data we have in the current context of the credit we are going to provide is often sufficient for us to make a robust decision.
So that raises another interesting issue that I'd love to hear Meng's take on, because traditionally we would say that your history of how you pay your debts should be the most reasonable way to assess your risk going forward. But you're not saying that. You're really saying, actually, the more, I may be stereotyping here, but you're saying, look, the more dependent you are on my platform to do your business, and not just your financing, the more I can depend on you because you don't want me to cut you off. So while we talk about this being unsecured financing in most cases, it's being replaced by the collateral, if it will, of your need to be in other parts of my ecosystem, without which your access to markets is limited, right? Isn't that the same way it works in JD?
Sorry, maybe I misled you before. I never say that the big data can replace the data with strong characters. In other words, structured data. Actually, In my personal opinion, I think big data is very important, especially for the long tail of the customers who don't have the credit information from the traditional financial organizations, but they do have the real need to get money, to get funded. But in another way, I think the big data is not omnipotent and can't replace the traditional data with strong financial characters. In my opinion, if we can get both source of the data, I think the traditional data is even better to the alternative, to the big data, because they tell strictly to us what information we want to get. But big data is, with no doubt, a good supplement to the old one, to the structured data. And what we do now is to try to combine this together, because sometimes big data may tell lies. Here is an imaginary case. If we want to design an app to apply on the applicant to help us select better candidates, and we train the app with a lot of big data we collect from our company. I mean, the successful of the candidate. The result could be bears, because it can eliminate most of the women, female candidates. So we can say, although big data is a good thing, is innovative, but it has its shortcomings. So what we do more now is to combine the two parts of data together to do the joint modeling and make a better result.
Okay, very, very interesting. Now, Sarah, to what extent in your system, I mean, you're moving data across borders, but what's your sense of traditional versus non-traditional, traditional versus alternative? How are those issues figuring in your modeling as you're trying to build? I mean, obviously, in the long run, we all want the overall data system to improve, and we want both. But what role do different types of data play at different stages in your life cycle with your customers?
Yeah, I mean, to date, we've focused largely on pulling what we're all calling traditional credit data through. But I think, we've said it a few times today already, the fundamentals of people borrowing money and people repaying money turn up in lots of different data streams. And so we don't have an adverse reaction to other streams of data, that we're seeing that we might call alternative data. We've just not necessarily brought all that through. But the essence really comes back to whatever we can find that allows us to get that notion of borrow and repayment is sort of where we're at. The one thing I will say is when we look at the immigrant population coming into the United States, there's about 2.5 million people coming in each year. Our estimates are that only about 50% of them have credit data in terms of their traditional sense. So we're already aware that we need to start thinking about bank transaction data, utility telco streams, in order to supplement and actually create thick files for the rest of that population. So for us, it's sort of it's a matter of sort of when and how soon as opposed to if.
And Samuel, as Creditinfo enters different markets, how do you, I mean, I don't want you to give away trade secrets or anything, but how do you make determinations about your data acquisition strategy and how much emphasis you put on different sources?
Yeah, well, I think from a credit bureau's perspective, I mean, payments are transforming from physical, as we're used to electronic. So this kind of information is critical for us to see this kind of transactional data, which is more or less more up to speed and than the traditional data we are exploring, which is often historical data. So capturing these data sets is very critical for us to support access to credit, and working with companies or like Grab or other companies which do have such transactional data is key for us to actually succeed in these markets.
And look, if we look at the Grabs and the JDs, you you have your own data reservoir, and it is being refreshed in real time. And so you're, in theory at least, able to be re-examining, rescoring your customers ad infinitum. Whereas your two bureaus, even if you negotiate with them, can you get the same? I mean, to what extent is that real-time access important? Because we haven't really talked about the temporality of all this. We've talked about different data types and what sort of machine learning, artificial intelligence, but how does the frequency of data refreshment compared to, say, traditional financial statements where they get done every quarter or every year, every whatever, how is that affecting your approaches and your work? Who wants to?
I'll take a shot. I mean, for us, one of the things you do have is that as the consumer has now sort of arrived in the US, and if they're not engaged in their home country file, that data is slowly becoming stale. The file is becoming thinner. So fundamentally, you see the score deteriorating, which is sort of a natural phenomenon. Again, our approach here is we will continue to ask consumer permission if we're pulling that file again. But we're also looking now to look at what data do we have on the US side that we can supplement and bring in multiple data streams in order to create that file, both from the home country and the US. So it's sort of a blended picture. Ultimately, we'll then build a score around all of those data streams in order to give the most comprehensive representation of the consumer's risk.
And so for Greb and JD, to what extent is this constant refreshment, call it whatever, an important, and to what extent is your model based on analyzing that and pushing out suggestions to your customer base versus the traditional, well, I wait till the customer applies and then I figure out what I need to run based on the fact that they've come to me and, well, sorry, there's a lot of push that goes on in the traditional model too, but to what extent is your relationship dominated by push versus pull, would you say?
Yeah, I mean, for us, our predominant approach has so far been pull. So we would like to understand the need at the point it arises and be present, and rather than waiting for someone to, come and ask for it, right? So I don't know.
But just I would call that push,
okay,
just for my,
okay.
as opposed to waiting till the customer says, I need insurance, you'd say, well, look, based on, we're seeing some patterns here and we'd like to offer you something which might be good for you.
Right, so now, I think the distinction is whether the marketing message is so overtly, I'm offering you, versus I'm here.
Okay.
I think there's a more marketing point of it, which is we believe in being present as an option when you need it. But to be present as an option when you need it, we need a lot of customer context and data based output. That when can we be present, to what extent can we be present. Like if there are 5 merchants, I can't give $100,000 to all 5 for 12 months. To some I can, to some I can't. That decision we would like to make at least as a first rate within our own abilities. And then only if there is interest, maybe we can pull additional information from outside the ecosystem to firm up that decision, refine that decision. We always look at things in at least 2 steps.
Okay, and from JD's side, how do you decide how you're approaching your customers? Do you like to be pushing out to them, here's what we see in you, here's what we think might help you, or to what extent are you hoping that they will come to you and ask you for things?
We did this kind of work in both ways. We push our product to the selected customers. Also, we have we have millions of applications from customers on our app. So it works on both ways. And the process is very quick. For a small amount of lending, it only needs 3 seconds to make the decision.
So you're following the same 310 model we heard about 2 years ago when our colleague from Ant Financial was here and telling us about 3 minutes for the decision and 1 minute to deliver the funds and 0 physical contact. It's a pretty similar experience in the JD context. Very, very interesting. Now, 2 of you represent, you're not seen as financial sector institutions primarily, and 2 of you are. To what extent is that changing the way your relationship with the regulations and the regulators that exist in the markets in which you're working? Who wants to say, you know, and to what extent does the degree to which you are trying to pull different types of data influence the way you're interacting with the regulatory framework? Anyone want to be brave? Otherwise, I'm going to pick on Sarah to talk about cross-border because that's a really interesting.
I can talk about it a little bit. So, you know, we sit in 2 different situations here. On the U.S. side, there's, you know, quite a lot of receptivity to what we're doing because we're looking at a population that's underserved, underbanked, essentially credit invisibles typically. So we have a lot of engagement and interest and support for what we're doing, and receptivity to helping us through some of the challenges we have with regulators on the US side. So as long as our data looks like everybody's familiar with it, we're all good. You know, on the other side, in terms of the home countries, there we have you know, much more sort of complex conversations. We have to sort of explain and get through the idea of consumer permission, and then whichever market we're in, if it's you know, with the UK, GDPR, some of those dynamics. And there are various sort of tiers of regulatory focus and scrutiny for each of those markets. So it's a much different perspective on the home country side. But fundamentally, I think, you know, as long as we're transparent, and that's important for us, that we've tried to be as transparent as we can, we've not had a real challenge kind of putting our model in place where, you know, sort of, you know, there's receptivity to the fundamental principle of giving access to credit.
And what has the Southeast Asian experience of Grab been like?
So I think, you know, Grab, when Grab started, our initial years had an approach which was at that point right, that we are really shaping an industry from many ways which didn't exist, right? And first you shape it from customer need perspective, serve that need, and of course then regulatory wise that gets shaped. I think when we went into financial services, we realized this is not an industry that is out there to be shaped. There is a certain shape that exists to that industry. There is a certain set of players and regulations and boundaries that exist, right? So we are, in financial services, we are very much, rather than just, you know, getting and solving customer problem alone, we are really cognizant, and we're in direct, you know, sort of, I would say, co-solution mode with the regulator. Because we believe whatever we do in financial services, first of all, for it to be sustainable, for it to scale, for it to have impact, it has to be within the regulatory framework, right? So we've been generally, I would say, across the region, with the different markets, regulators' approach tends to be a little bit different in terms of how directly you can engage with them or not. But wherever we have been able to articulate what we want to do in terms of who we want to serve and how we want to serve them and how we are using our assets and partnering with existing institutions, we are not here to just, you know, disrupt the existing stability of the system. We have gotten fairly proactive, positive engagement. What they then realize is we may not fit the existing structures of regulation in terms of, let's say, KYC or contracting or the risk models, and they tend to create space for us to at least pilot and, you know, be in some sort of a sandbox. And now there are new licensing regimes that are coming up, which might be, I guess, better suited for the type of stuff we want to do.
And how about your reporting obligations? So, are you sharing data on your lending, on your insurance clients with the corresponding regulators in the same way that more traditional financial institutions are sharing in those environments? Are you being asked to? Do you anticipate being asked to?
I think that's a very jurisdiction and license-specific situation, right? So we are a licensed lending entity in many markets, and in those markets, according to those licenses, we are subject to regulatory reporting and reporting to bureau. Like in Thailand, we have nano license. According to nano license, we have to do regulatory reporting. Same for Philippines. It's quite a defined space in terms of how the status quo works. I think there's a separate question on, how would this whole thing evolve if you want to capture alternate or non-traditional, non-banking data into a certain aggregated entity. But that's a different shaping, right? In terms of how we currently are, we are very much aligned to whatever the license regulator allows us.
And Meng, I know the situation is evolving in China. I've said revolution, not evolution, but China is definitely in an evolution situation. But so what's JD's, its financial operations? What's your relationship with the CBRC and the PBOC? To what extent are you now sharing the data on your financing with those common databases, and how do you see that changing over time?
Because the fintech industry in China, even in the world, is quite new. So both sides, the regulation side and the business side, they are learning they don't have any experience, regulatory experience in this area. So both of sides are learning and rejecting from time to time. Frankly speaking, as the early stage of this industry developed, the regulatory environment is very friendly, and thanks to that, we don't have any GDPR, so it stimulates a lot of innovation. We can say that China has now achieved a cashless society, and the fintech industry has also has the systematic importance in this market. On the other side, the friendly environment also causes a lot of problems, as you mentioned, the P2P industry, and makes the image of the industry very bad. So it can be understandable that the policy and the regulation will be stricter and stricter in this area. And as the top player like Ali, like JD, actually we are welcoming this evolution, because there are so many players in this market, and some of them don't have the ability to capture the data and analyze the data, and it's not very safe to let them survive in this industry. So actually, as a big player in this industry, we are welcoming the stricter policy, and our role is to embrace the coming policy.
Very interesting. So the situation, having been very loosely regulated, has enabled a lot of innovation, but now the market seems to be at a point where the data governance is becoming a growing concern, and also standards of behavior, if you will, of the codes of practice are being talked about. So that's in the different markets that Samuel, that you're working in. How are things changing with respect to the way regulators are are dealing with the traditional financial sector versus because you're dealing in many markets too, where they're newcomers in the financial sector who are becoming more significant, or newcomers in the data sector relevant to financing that are becoming increasingly important but haven't been traditionally under the remit of the financial sector regulatory authorities. What do you see as the trends there, and how's Creditinfo trying to deal with that?
Yeah, well, on these fintech online lenders, as we often refer to them, and as has been discussed here today, I think the regulation is not like 100% clear, and it's in some cases we are seeing proactive regulations taking place. For example, we have seen where debtors have been shamed with some of the online lenders, which is something which is not normal standards. But a more reactive approach, I think, we're seeing a more reactive approach now from the regulators, but no market is the same. But I think this needs some serious work and consideration. So it's different, depends on each market, basically.
And how we talked today in several occasions about privacy issues and how you balance data potential with data privacy, and also how it might be different between consumers and SMEs. In your markets, I mean, among the example that we joked about as we were preparing this panel is you use facial recognition technology, but you use it on cows and pigs to help find ways to do innovative agri-finance. And we haven't heard them complain yet, but in a more serious way, how do we see the attitudes in China changing toward this? What do you think are the implications for your financial operations, and how do the rest of you see this in your markets too?
It's a good thing that pigs never complain. But it's much more tricky to adopt this, to apply this kind of cutting-edge technology, especially related to the data collection. Actually, we don't have the conclusion yet, but both sides are learning and trying to find a middle way. A new company called Biennial Credit just established by PBOC, and its role is to collect the data from all the big tech company and to manage and standard the data by itself. And so it should be a right decision. I think the data should be managed centrally, but without doubt, it works very hard because data is the most valuable asset of each big tech company. And although it's an administrative order, all of them are reluctant to provide the data to them. So we compared with the Chinese pattern with other countries' pattern. Last year, I talked with the expert of Aadhaar in India. I think their pattern, the math side is good. They, take the biological database, for example, they centrally managed and collect all the biological data from their citizens. It should be an effective way, because in China, we can say that Ali collect facial recognition data, JD collect data, and Tencent also collect data. It's like a data island or data chimney. It's a waste of energy and a waste of resource. But on the other hand, it will be very effective to let the market organization to do the technology innovation, especially in this data collecting area. And then maybe there is a combination way that the data should be managed centrally, but the innovation can be compete with the market organization.
Interesting. So we've, because there was very loose regulation, you've created these massive data islands.
Yeah.
Now the government's moving to create a central coordination
A lot of
reservoir, whatever you want to call it, and it'll be very interesting to see how that affects the market. So you all have been a great audience, and I want to give you lots of chance to have questions, and because I saw that in other sessions there were hands raised that we couldn't get to in the end. So raise your hands if you have a question for this group, or if you want to take up issues from previous sessions with this group that we haven't fully surfaced. And we'll try to take several questions at once, and then I won't have every panel member answer every question. I want to try to get as many of you in as possible, because you've been a great audience and it's late in the day. So please raise some hands. I can sort of see through the lights to you, but raise them high so I don't miss you. And I surprised everybody, so I don't see any hands yet. Or is there a hand? Am I missing something? It's hard to see through the lights. Is there? Grab a microphone if I'm not seeing you, and then just introduce yourself and ask a question. Okay, I see something back. Tony, we all know who you are, but we can't hear you.
There we go.
Much better.
Yes, I always have a question just in case, but I was hoping somebody else would ask one. This is probably more directed towards Nova Credit, and I just want to take issue, Matt, with something, a reference that you made to data reservoirs. Right? I don't consider these to be data reservoirs at all. These are data puddles. And the problem from a consumer perspective is that there are now hundreds of thousands of these puddles of information about me all over the place in all sorts of companies. Now, in the old traditional credit bureau model, you could pretty much guarantee that most of the information that you needed was in a single repository. Now we have companies who own valuable information about me across multiple industries and multiple jurisdictions. So my question to Nova is, from what I understand of how your operation works, you're basically creating a data wallet on a subject from one country that he can then take to another country in order to get credit. Do you have any plans to expand this to allow other people to own their own data wallets so that we can collect ourselves this information that is held about us through all of these companies and create our own full file?
That's a great question. So let's just try to take a few more. Now that Tony's broken the ice, I hope others will be bold and raise hands. If not, I will take Tony's question, but just want to make sure. Sorry, I'm squinting. Okay, let's take Tony's question. To what extent can we make puddles into bigger things, and not necessarily, and to what extent can we give consumers control over how their data from puddles can be utilized, and by whom?
So I think we've heard today that certainly the technology is in place for us to make that happen, and the data is available in lots of different places. As to whether Nova would go down that path, that will be a function of sort of where our business strategy evolves. I wouldn't say it's immediately on the horizon. We've got a lot of things going on right now, but I mean, conceptually it's there. You see even American Express announced their green card that has a blockchain capability with it, that you can store all of your information associated with Amex, on that facility and stuff. So we're moving into that place. For me, if I look at it from not just the data pieces, but how do I develop a risk signal out of that? The real challenge now becomes how do you kind of build some analytics around that? So I think that's sort of another step. We've sort of again got that technology in place with machine learning and some of these things, but it's all before us. It really becomes, I think, the consumer receptivity and the market receptivity.
And as you were saying, because when you look at it in the light of Nova's own strategy, you have to, as an individual entity, you also have to ask the tough question of it. Well, I could invest in this, but is what I'm doing just going to be showing all my competitors, if I'm first, all the mistakes to avoid, and then they're going to walk over my body to achieve what I was trying to do? So it gets into the prisoner's dilemma. What's the obligation of the industry to move forward versus to what extent the public sector should be involved in risk reduction and coordination in helping markets to evolve, if you will.
Yeah.
Where we can see the long-term public good, we can see the long-term private benefit, but getting from here to there is not so easy always. And it's fraught, and for the first mover, it's fraught with the most peril.
It is. And I know Tony and I had a little bit of this conversation last night. In one sense, the Nova Credit idea is a relatively small idea compared to the 230 million consumers in the US or any of these other countries that have data and scores around. And we're messing with 2.5 million, a year. But fundamentally, what we've done is shown that the process of cross-border data transfer can work. Consumer permission can be an important part of that. Risk analytics can be a part of it. So, all of that has sort of now got substance to it, and I'm hoping that we'll see more and more of this sort of innovation playing out in different parts of the industry, and who knows where we'll end up with it all.
Great. Other questions? No, you can't be that tired. There we are, right in the front, and then here. We'll take these two, and any more hands? Sorry, we'll take, Luis, because you've had two, I'm going to take this one, and then go back to you. Okay? Thank you.
Yeah, hi, I'm Jane from BIIA. And I'm actually following up on the points that was raised in the earlier panel discussion, and this would be relevant to this panel as well, because they are collecting data on consumers. And we as consumers would be interested really in terms of where you're collecting the data from, how reliable is the data, and that brings me to what Mike has raised also about being transparent and whether there's any baseline guidance in terms of, you know, what is the level of transparency that should be accorded to consumers. And if the data is really not quite accurate, would consumers be informed and we have the right to have the data amended, like with traditional data?
Great. So here in the middle.
Hi, this is Antoon Masad from Seed Rose. With regards to consumer data, I'm sure you all have your compliance in place and GDPR compliant and so on. There are talks now about monetizing the data from the consumer side, i.e., if I have my data stored with you, I should be able to share part of the revenue that you generate from selling my data or verifying my data. Has this been considered, and to what length yet, by the credit bureaus?
Great, and then we'll take Luis's question, which if it's also on consumer rights would be perfect. We'll have a nice coordinated set of questions here, but if it's not, it's still okay.
No, it's related to consumer, but it's just a step further. So I didn't mean to make any more questions, but I think it's, why not? It's a good, golden, great opportunity. Who knows, when are we going to have you all together? So my question is very simple, is probably you have experienced this in the past. When you have a consumer and he make his first loan, well, he needs some prior experience within your platforms. Otherwise, you cannot escort properly this person. And then this person runs his own business. He becomes a sole proprietor. When he becomes a sole proprietor, his funding needs are higher. So he will probably need more funding, and probably your institutions will not go as high up. So have you come to the point where this person will need maybe 1 million funding, but you cannot afford, or it's not under your rules? So can you share, or can he allow you to share this information with other financial institutions so he could fill the gap?
Okay, so that's three very good questions, and they are related. So, the first one is about reliability and transparency when you're collecting data from all these different sources, and how do you afford the sort of rights as in the 2011 general principles on credit reporting to the consumer to know what's there, to check if anything's wrong, and to correct. The second question, which is, to what extent should there be a right of consumers, since this data is valuable, to monetize that, and what are the obligations from the side of the industry to enable this? If you're getting value from it, to what extent is, and then finally, if you're dealing with those at the interface of personal and business, and the sort of the needs the requirements for financing get beyond a certain level, and that's beyond the level of your institution, to what extent are you able, and should you be able to share with others, and under what conditions that the data that the consumer has shared in that case? So you don't have to take all of them, and I hope no one of you will try to take all of them, but who wants to take any one of them and start us off?
Yeah, I think from a credit bureau perspective, we of course are following specific guidelines in terms of Credit Bureau Acts. So when we are storing data, which is not always the case about individuals, consumers, the individual and consumer always is informed that he has access to the data that is being stored in the database through a self-inquiry reporting platform. So this is extremely important and has to be transparent. So of course, as someone said here earlier today, if we lose the trust or are doing something which is not according to the Reporting Act, of course that's not the way that we can work. But data is not always being stored in terms of alternative data. When we're looking at the fintech and online lenders, in some cases, we are basically, we are not storing any information, we are doing the calculation through the actual lender. So it varies depending on market and also client and how the data is being used.
Very interesting. So as you enter into partnership relationships where you're not in the traditional sense aggregating the data and creating your own reserve that you're building your services out of, but you're actually functioning as a service provider to somebody who's holding that, then the obligations seem to be, they're different. But I guess that begs the question, should they be different? Essentially, the potential for abuse is the same, right? Whether you're dealing with somebody's monopoly database or a public or a more aggregated quasi-public reservoir that you're creating as a licensed aggregator.
Yeah, I think, as said before, I think improvements from a regulatory perspective need to be made, and I think there was a question in the previous panel discussion, at which point are you actually giving away information? You basically don't have any other option, so it's based on consent, and this consent is also implies how the data will be treated and so forth.
And just that gets into the second question where maybe I didn't, and if I'm phrasing it wrong, but I'm sensing this issue that, and I'm not asking you to state an official position on behalf of your company, but you know, it's an issue that's very, who really owns this data? And if it's the consumers or the business's data and you're using it, do we have any obligation to, and it's valuable, what obligation do we have to the provider of this data? Because right now there isn't much, right? I mean, but should that change over time? Anybody want to speculate on that?
Well, I mean, again, not representing my company's view, because I'm not sure there is a view that the company has or anybody. Just in the spirit of the discussion, right? I think it's quite tricky because there's a clear separation. If I'm using the data that I capture about an individual to offer him or her a service that is valued by that same individual, there has been one argument is there has been a fair value exchange between the two parties, right? I didn't sell your data to somebody else and made money. I used your data to offer you a service that you took, right? So in that context, a value exchange, one could say, is fair. You had a choice not to take it, right? It's quite different if I took your data and created something out of the data and then sold that or monetized that without you being present in that value exchange in any direct way. So let's say I created a credit score out of your data and then I sold the credit score to somebody else and then that guy gave you loan. Then I see this. So I'm saying there is a distinction that I would like to draw between where the data that you have given to me has allowed me to offer a service that you have accepted or not accepted, but I have offered it to you on the basis of true value, fair value exchange, versus where I've taken the data and given the data or sold the data to somebody else and made money out of it.
Okay, but equally in the spirit of just the conversation, right? Even if I don't sell that data to another party, if I take the data from you and then I'm dealing with another one of my customers and I'm using your transactional history or whatever to build my model so that I can do more services to more customers, which is making me more money, aren't I still in the same way earning from you, and do I owe anything to you for the permission to be able to use that data again and again?
Oh, but in that case, credit scoring models are built on people on whom it is not applied, not necessarily. I built credit scoring model on 1 million borrowers who borrowed in last 10 years and then applying on next 2 million borrowers. So now, am I paying back the 1 million borrowers on whom I built my credit scoring model? No, right? So, I mean, there's no different standard here. Like, yes, we created a model out of somebody else, now applying it to somebody else who looks like the person I created it out of. There is no value transfer I'm generally thinking about. So it's not a new paradigm.
Well, but from the standpoint of, I mean, we haven't queried this in the past, but does that mean we shouldn't query it. I'm being devil's advocate here. I'm trying to get more hands up too. To what extent do we need to query it in the future, particularly when, to go back to the TechFin versus FinTech article, maybe we didn't mind when all this was doing was helping banks to put more people, to give more loans to more people. But if now Facebook, to use a deliberate example here for reputation reasons, is capturing this data, and let's say they're going to start a financial service company using, Libra, and they're going to suddenly, and they're basing it on the 6 billion people I saw in the news the other day they have using Facebook, and the data that they have, which they paid nothing for. Then do we feel the same way about it? I'm just, does anybody want to talk about this? And yes, please, Anthony.
So I think what I'm hearing in this debate is the social contract. If I understand what the rules are about how information may or may not be used, and I can choose to enter into that environment or not, then all is fair. The problem, I think, is that the choice to not enter is not really, it's a false choice. It's kind of like, you want to use the Wi-Fi, click accept to the terms of usage. Well, I need to use the Wi-Fi, right? So I think that maybe part of the future of this debate might be that the social contract needs to change. But for today, it's easy to put Facebook up there or put Google up there and say, well, if you're logged into your Gmail account and you do any searching on Google, they know who you are and what you search for. You make the same argument for many platforms. If you're logged in, they know what you're doing. And we don't necessarily understand all the terms and conditions, but we understand that we're giving up information by being there. At some point in the future, it could be dystopian if every single use of every single piece of information requires my permission. I'm going to be constantly approached for permission to use information. I'm going to drown in all of those requests. So I think we have to get a better model than just the two ends of this spectrum are one, well, just don't play. And the other is, well, I'll ask you for your permission for everything I want to do. There's got to be something in the middle there, doesn't there?
Well, that's an interesting, yeah. I mean, that's a very reasonable thing to hope for. And to go back to our question from the Bundesbank about ICCR, maybe that's an area I would gently suggest of where we haven't really spent enough time, and maybe we need to think about where the standards, what might be a sensible place to put standards. Yeah. Because can we assume that without standard setting, and that the markets are just naturally going to come up with this? I don't know.
I mean, I think that's a great point, because I sometimes wish that Google gave me a dumb version of Google which doesn't capture every data about me. Google will tell me, oh, it's going to be very dumb. It would not be able to predict what you're thinking about, what you want to eat. I'm okay with that. Honestly, I'm okay with that. I'm okay with the dumb version of Facebook. I'm actually okay with no Facebook. But anyway, but none of these platforms seem to give you a real choice, really. The only choice is it would not work if you don't give me data, and it would work beautifully if you give me every data. That's a false choice. I agree. So I think, yes, this is possible for an utility type platform to be pushed to give a choice, which is, it is going to be dumb, and it's fine that it is going to be limited functionality, but your data is not getting captured and monetized in some whatever environment, right?
We tend to think of information provisioning as either I give it or I don't give it. And we think of a switch. It's in or it's out. What I'm envisioning in my head is sort of a slider. Here's how much I'm willing to share or how little. If I'm willing, if the younger generation, we now have a group of digital natives that are being born to digital natives, right? So they not only were born in the age of the internet, their children were born in the age of the internet. Maybe they don't care. Maybe they push that slider all the way over to the right and say, I don't care, learn whatever you want. Me, I'm going to probably push it over the other way because I don't really, it's not that my searches are that interesting, it's that they're my searches and they're none of your business. And if that means your search engine doesn't work so well when I'm trying to figure out the height of Mount Everest, I'm pretty sure the height of Mount Everest didn't change because you don't know who I am. So maybe it depends on what I'm doing at the time too.
Well, or if you take an example from our panel, if you look at what JD, how that's evolved in China, as Meng was saying, today they're offering a whole range of financial services, including to remote rural areas and traditionally difficult areas to manage risk in, like agri-finance. But they're able to do that because they've been capturing this data since they started becoming a connection for markets between buyers and sellers. You know, you could probably ask the Chinese customers, the tens and hundreds of millions of Chinese customers of JD, is this okay? And because they didn't get services before from the financial system, maybe they're okay with it, but will they be okay with it forever? Is this something that needs to be?
Yes, something need to be changed, and it is changing now. We are now give the customer options to choose. And there is a new regulations just released in October, I think. When we collect data, we should get approval of the customer. And when we apply the data, I mean, every time we should get approval again. Usually, it used to be like this. If we collect the data and get approval, we can apply it in many ways, like in security, like in prices, marketing. But now, if we collect data, we want to do the anti-fraud service, we should check with the customers. And if we want to do business about pricing, marketing, we should check with them. It seems like it's have a negative effect on the efficiency, but I think it's a safe and right way to do it now.
Very, very interesting. So even in China, which we think of as, you know, the Wild West, if you will, of free and easy access to data, seems to be evolving. And it'll be very interesting to see how this plays out. Did you want to say something?
Yeah, I think from a credit bureau perspective, this is also a lot to do with educating the actual customer. Why are we collecting the following alternative additional information from you? Because you need access to credit, you will repay your loan, you will improve your credit score, so it's to your benefit. So I think this is something that we might be lacking a bit and need to improve. And sorry, question?
I didn't mean to interrupt you.
Oh, it's okay. Okay, so it's also to do with like financial literacy around collecting this data.
If I could just,
please.
I'm sorry, I'm not trying to join the panel here, but there was a famous case a number of years ago. So what you said was, we're going to collect your information so that we can do a better job of scoring you so that we can serve you better and more accurately charge you basically for this or give you some other benefit, right? That makes a lot of sense. One of the arguments for collecting personal information is often performance. We want to make sure, if we know who you are and we know that you're the same person next time, then we can better manage your experience. There was a famous case a while back where there was a flashlight app. Before phones had the ability to just turn on the light, you had to download an app that turned on the light. I'm old enough to remember this, right? And this flashlight app was free. You downloaded it and, oh, look, I can turn on my flashlight. Every time you turned on your flashlight, it was sending data back to the company about where you were and a device, somewhat anonymized device ID, but you could tell that the same person turned on their light over here and over there and over there. You didn't know who they were, but you knew where person number 123 was when the light was turned on. And you could similarly map similar people that turned on their lights in similar places and track their movement. Well, I think that's beyond the creepy factor for just using a flashlight. And then their argument was, well, in the terms and conditions, it said we have the right to monitor data from this app in order to improve the performance of what? The flashlight? So I think that we can take it too far. I didn't say you took it too far, but it can be taken too far that anything that starts with for your convenience, we will collect certain information to improve the quality of the meal on your flight. Maybe not.
But, but what are we discussing here? We're discussing financial inclusion, how to facilitate access to credit.
If you say that you're collecting my information to facilitate my financial experience and you use it for that, God bless.
Of course, that's the whole idea.
But if
here.
you also use it for something else, we might have a problem.
If the flashlight app has predictable power, I will use it.
That's an interesting way to look at it. There's a question, there's Tony's.
Yeah,
but hold on, I thought I saw another, just Tony, before I go to you, I saw another hand here with someone I haven't heard a question from yet. Can I just go to the middle?
It's not a question, it's just an addition to what Anthony said.
Okay.
And it's maybe a suggestion or a recommendation for those of you that are policymakers. The genie's out the bottle in terms of the data. You're not going to get it back in. So we need to find that happy medium. And if you want to start somewhere, have a look at the terms and conditions and have some standards around terms and conditions. So firstly, people can understand what they're signing up to. And secondly, you don't just tick a little box and go straight to the app without actually having to read the terms and conditions. I think you could put some rules around that, it would make it harder to get the app in less than half a second, but it might actually force people to speak English in the terms and conditions, or at least whatever language you want in the terms and conditions that's understandable by consumers, and it might actually prevent some of the misuse of the information or the carte blanche availability to use data for whatever purpose. I think that would be a very sensible place to start in terms of rules, regulations, or even just standard practice.
Great, so let's go to the question in the middle.
Hey, this is Mark.
And then we'll go down front. We'll take multiple questions. So
I have a different question on a different somewhat topic.
And just
this is Mark from S&P.
Thanks.
Yeah.
I know people know who you are, but just
quick question. I love the whole revolution, not evolution. How do you test your models for when the economic cycle goes down? It's all been good last 15, 20 years. FinTech, all great. Data, all good, right? Good economic cycle. You got good data. That's all good. How do you test for when it comes down?
Great. That's an opening up a whole new area. So here.
Yeah, I mean, I don't have a question, but just a remark, clarification.
And please,
as
Fabrizio,
we talk about standard, Fabrizio
introduce.
from World Bank Group. As you talk about standard, we do have a standard for that, and it's called General Data Protection Regulation. So all European citizens now are protected by the fact that the tick in the box is not any longer a free riding passport to do whatever you want with your own data, okay? Which means that if I tick the box for Facebook now, it's a social contract, as was mentioned before, but specifically for the usage of the social platform, which I can accept or not, but what the GDPR want to prevent is that then my data would be used to be sold to Cambridge Analytica for influencing the next electoral roll. So that's the precise point. GDPR was designed precisely to combat the false myth of the consent, as the consent should be done with a specific purpose of the usage of that specific tool. So if I sign, if I tick the box for the consent in application for using the lamp, and every time the lamp is used, send my data somewhere in Sierra Leone, that's not what was done for the purpose. So GDPR is precisely the new regulation that help in mitigating this issue, to ensure that the social contract is basically around a very clear, format and with a very specific limited purpose for that. And that's why many jurisdictions are now trying to scrutinize better the result of GDPR, because that's the newest piece of legislation that can then help really consumer combating, the abuse of data.
Okay, so do we have any other questions? We need the economic cycle, the macro question, but are there any other hands? Sorry, it's hard to see through the lights, so please put them up high, or does anybody else have a microphone that has a question? Okay, let's take the economic cycle question. Who wants to venture how robust we believe the models are? I mean, you want to say something from the standpoint of Grab?
Yeah, I can have some response to that. I think we realize that a lot of the data is untested through economic cycles, but that's also is a fact that we consider in terms of the products that we power with that data tend to be very high frequency, low tenure products. You're not going to give somebody, again, a 20-year loan based on alternate data of how many rides he takes in a day, right? By the time we enhance our models to make credit decisions which are for longer tenure loans, we are building in a lot of existing traditional data in the model itself. We're not trying to power those models just based on purely alternate data. But what may end up happening is, of course, with history, we will start realizing the contributions of different data signals. And then if it turns out that a lot of the traditional data wasn't not necessary for even the longevity and stability of the models, then we can always dial it down. But we're not going into it thinking that, oh, this whatever alternate data is going to give us models of 20 years of risk prediction. No.
So it's important to emphasize that we're talking about mostly short-term, fairly sort of merchant advance or working capital type of products where maybe the macro risk of cycles is less, and there's also innovation in the products themselves. I mean, many of you, I'm not sure to what extent Grab and JD are doing this, but many of the new players are offering products that themselves are varying the repayments based on the inputs coming, the payments coming into the customer. So instead of you pay every week or you pay every month this much, you pay X% of the flows coming in. And that's happening in the US, it's happening in Kenya, it's happening in Indonesia. And this, even in the short term, in theory, might mitigate secular short-term risk because you're not going to be starving the client if they have a blip or because there's a cyclone or something out here, but you also might be enabling them to pay back faster if business is good, right? I mean,
with drivers, exactly that's what we're doing. With drivers, we realize there are two issues. One is they earn daily. So if you give them traditional loan products and ask them to repay once a month, it's very difficult habit for them to form that they take few dollars out of their daily cash flow out and save it for a month, and then they can give you $100 end of the month. They can't do that. It's very difficult. It's a lot easier for them to give you $2 a day. So our driver lending programs are all automatic deductions from their wallet, which are $1, $2, $3 a day. The second problem, but then when we started that, we realized there's a second problem, which is they don't essentially earn $100 every day. Some days they earn 50, some days earn 150. If you start deducting at $3 a day, some days $3 is not meaningful, some days it is a lot more meaningful. So even if you deduct the same amount every day, we realize you can't hold him or her responsible for not paying one day. So what we do is, while we deduct every day, we allow it to stack it up, and only if the person hasn't fully met her obligations in a period of 1 to 2 weeks is when we start taking note of that as a signal. But that itself has solved a massive amount of cash flow problems, credit problems they used to have previously, because they just did not have the financial habits of saving $1 in order to pay all of that to service a loan rather than buying something for his or her kids, right? That is not the mental model.
And I've even heard about similar innovations happening in InsurTech for small firms where instead of, oh, you have this policy and it's the same all year round, it can vary. I have a big job with this customer, so my insurance is, for the moment, I have this, and then so are you doing that also beyond credit?
Yeah, we have exactly that. It's a daily insurance product, so if the person does not drive the car, then he doesn't pay premium for that day. We just launched it in Malaysia. It's a pay per day. In fact, we are trying to now convert that to not just pay per day, but it has some link with the number of kilometers that he or she drives. Because why would you pay insurance if your car is just sitting out in the garage, right? And a lot of our drivers are part-time drivers. They do that to add to their income, and that is not their only source of livelihood. So we are making these things, changes to make it affordable, right?
So we're down to our last 10 minutes. Let's take some more questions. Or have we completely knocked you out? No? I mean, let me go back to the panel. If you were going to give some advice to, two of you are already in the credit information industry, two of you are are using credit information extensively. But what advice would you give to the BIIA members, building on the earlier discussions we've had about how, if we really want to focus on inclusion, how we need to rethink approaches and how we need to rethink, and my next question after this one, just to give you heads up, is going to be the advice we would give to policymakers about how to enable what we're recommending the industry think about doing.
Yeah, from a credit bureau perspective, I think basically, the online fintech lenders, this is something that we have to pay attention to. Our company, and I have been involved in this for years now, we focused a lot on alternative scoring solutions. And we approached the traditional banks with these solutions, but the regulations, IFRS 9, Basel regulations, not allowing the banks to take significant risk, basically shifted the whole kind of approach to the online and fintech lenders that are approaching these unbanked segments. So I think start paying attention to them, get them more involved in terms of regulations, data protection, privacy, and so forth. I think this is kind of the new era in our industry. I think that's critical.
So although we said this panel is revolution, not evolution, as in the previous panel, the power of partnerships and rethinking the notion that we do all this ourselves, no, now we have to think about how we deal with different niches by different partnerships, and being more open and flexible is something that our revolutionaries are advocating too, it seems.
Yeah, I mean, I think I would build on that sentiment. There is an inevitability to what's happening here, and the encouraging thing that we heard today was we've heard about all the component building blocks that will move the industry forward in even more progressive ways. The other thing I think we should be aware of, though, is that there's a need for sort of perseverance, that we've got to sort of stay at the game here. And it will take a while for all of these pieces to fall into place, but all the right things are on the table. But we've now got to keep pushing everything forward, but we will get there.
And just with respect to Grab and JD, and especially as we're talking to the Business Information Industry Association, which I know most members are doing consumer too, and even though your work with businesses to date, it's dominated by relatively short-term, relatively small ticket deals, you're learning a lot as you're building quite large constituencies. What advice would you give about how, to the extent to which the traditional industry could be re-examining the way it's approaching business information and business analytics? What do you think are the lessons emerging from your own experience?
I think the key word for the future is cooperation. We are familiar with the model of B2C and B2B, but now there is a clear trend in China. The model is changing to B2B2C. The first B is a big tech with the ability of data process, and the middle B could be traditional organization, could be government. Because we have cultivate our ability to process data with our huge consumer base, so we can export this kind of ability to the middle B, and neither part can make revolution in this area, but with cooperation we can do the revolution together.
Okay, and from Grab's point of view?
Yeah, I think maybe when we look at the current credit-relevant data aggregation industry, right, the few things that we find a little bit challenging. One is the excessive focus on past credit information and credit performance is still somewhat self-limiting, because a lot of the data that we are looking for is not just whether the person has credit history, because most of them don't have credit history to start with. So we're looking for other data which can be structured and could be available through a shared utility. For example, let's say telco. Now, the reality is we're having to go and talk to each telco in each market, and it's not time efficient and infrastructure efficient for us to do that. So would it be, of course it would be great if some of these alternate data that has shown, it's not even alternate, it's basically just data that is useful in credit context, let's call it that way, right? If that gets standardized and then the case is made for the holders of that information to participate in a shared platform in a faster process. Otherwise, we just are going to work on our own island of data and try to get whatever else we can get bilaterally. It's just not a very efficient process from where we stand, right? And I think the second one is the use case of a lot of the data is also thought of as a very, can I underwrite my decision to give the person money? Oftentimes, we struggle to even, let's say in a SME context, to identify whether the business in fact exists. And if the business does exist, does the owner of the business exist? And is this person who is saying he's the owner, he's actually the owner, right? Forget about credit decision. I can't even actually, consider, establish the legitimacy of the business and the owner. Now, there is no data solution that exists in many markets that can just help me do that. There are business registration bureaus, etc., but they're not made for this sort of definitive use case. They're made for some other reasons.
So that gets back to the previous discussion we'd had about the importance of having a basic ID infrastructure so that we can do the AML, and the KYC in a way that's affordable to be able to continue to expand into markets that aren't being served. And at the same time, you also raised an interesting point about the, we have access to this previous credit performance, but present transactional performance can be critically useful, but it's not data that is very well organized generally right now, and its governance is not clear in many markets. And so, which is starting to segue into, I think, advice to policymakers, right? Because or is it the industry that can do that? Can the industry let me ask a devil's advocate question. Can the industry sort this out by itself, or is this an area where we need to get the policymakers involved and to come up with some rules of the game?
So the issue is, I don't think the industry will do it until the point it reaches a certain saturation because of this, right? The source of value creation in any type of decision often is asymmetric information. I have something that you don't have, and I believe what I have is immensely powerful, right? Until the point either the information becomes so dissipated that everybody has it, or the value of my information has been proven to a degree of narrowness that I don't think it is worth X and you think it is X by 4, I'm not going to let it go and you can't price it, right? So a lot of the alternate or whatever non-traditional credit information still hasn't been quantified to the extent where there could be a transparent value exchange that I'm willing to give it to an aggregator entity, right? Why would I give it? Because I think it's worth 3 times of what you as aggregator think it is worth, right? So that's, I think, is a challenge, and maybe there is some amount of regulation or structural push that can say, hey, hang on, this data has already been proven to be useful in across contexts, so let's not keep debating the same thing. Let's just put it together and create public good out of it, of which you can participate as well, right?
And that gets back to our struggle with answering Mike's question, where when there are macro changes and we observe what happens, if a lot of this has happened inside private black boxes, will we be able to learn lessons? Will we be able to take actions to, whether things stand up or they don't, how will we proceed? So that a lot of interesting challenges. So let's, with that, I think that's a good pause for thought. And with that, let's thank the panel. It's been really, really interesting. A little bit of revolution, but we've come back to a lot of similarities from the themes from the previous panel. So let's give everybody a big hand.